This is a brief lecture on Chapter 4 of Fundamentals of Financial Management, 15th edition by Brigham and Houston. This is focusing on the analysis of financial statements. So, in looking at this analysis, we will see information related to ratio analysis. We'll look at DuPont Equation, the effects on improving ratios. We'll also be looking at a little bit of information related to the limitations of analysis, as well as some qualitative factors. To start this out, let's look at the financial reports. This is information from the textbook, and so we see here we have a balance sheet for 2 years, 2018, and then a forecasted or expected 2019. This is focusing on the assets of that report. This next one, we see the liabilities and equity. One thing that it is important to identify is that last line, total liabilities and equity, as well as total assets, these numbers should balance or equal. We see the income statement. The income statement starts with sales, goes down to net income. We see that there is an EBIT number there as well, which is important to know. We also see some other information. So this is financial information that we would normally see in the annual report, maybe not directly on one of the reports, but maybe in the notes. And so we see here number of shares outstanding, earnings per share, dividends per share, a stock price, and any lease payments that there might be. So why is financial ratios useful? Well, one way is that it standardizes numbers and provides comparison. So now if we want to look at the ratio of two companies and determine which one is performing better, we would be able to do that. We would hope that it would highlight financial weakness or financial strength, and then we can also use this financial ratios to compare to an industry or compare to a peer through benchmarking or even trend analysis, looking at multiple years and seeing the trend of the individual company. So there are 5 major categories of ratios, and we'll look at all of these. We see here we have liquidity, asset management, debt management, profitability, and market value. So let's look at some of the ratios, some of the more common ratios. It is important to note that all financial textbooks have a little bit different spin on what ratios are included. We'll actually see some ratios unique to these authors, but there are some that are common to all textbooks. So within the case of liquidity, and so we're using information from the financial statements that we just saw. There are 2 major ratios. We have the current ratio and we have the quick ratio. The current ratio, we just take the current assets, divide by the current liabilities, and we get a number there. The next one, quick ratio, is just subtracting inventory from those current assets and then dividing by that same number. The current ratio is one of the oldest ratios that has been used by management to determine financial stability. Historically, the rule of thumb is that you wanted 2, but really, you really want to benchmark this against a peer, against an industry, to determine where you are relative to that industry. The higher the number, the more financially conservative the company is. They may be much more financially stable, especially in an economic downturn. And so we see some information here, and of course comparing it to the industry as well as trend, which we see is important. And so it is below the industry. The quick ratio, which is the most or a more liquid, the current ratio, would show that they are relatively weak compared to the industry, and it could be an issue where they may not have sufficient assets to cover any potential liabilities that need to be paid in a quicker pace. The next set of ratios is asset management. Asset management actually has a lot of different ratios that could be used. We're just going to look at 4 here. First one is inventory turnover. Inventory turnover is looking at the number of times per year you would turn over your inventory. And so we see here 4.1 times, so approximately once a quarter the company is able to turn over its inventory. The next one, day sales outstanding, is looking at the number of days it takes to collect on their receivables. We see here 45 days. This will be completely dependent upon what the trade credit terms were. If you remember back to chapter 3, we talked about trade credit. Are we allowing our customers 30 days to pay? Well, if we are, and it's taking us 45 days on average to collect, we have a problem. However, if our customers have 60 days to pay, they're paying within 45, that would be a good thing. The next two are turnover ratios, looking at the ability to generate sales relative to a certain type of business resource or asset. The first one, fixed assets. So we're just looking at usually what we would call property, plant, and equipment, and how much revenue we're able to generate from that. And then we have total assets. And so the total asset turnover is one that is commonly used because all companies have some type of assets, all companies have some type of sales, and so it becomes easier to use this to compare across industries than some of the others. But we see here there is a pretty significant difference. So there are some assets that are not fixed. Of course, current assets would fall into this category, but our fixed assets, we are producing basically $8.61 for every dollar of fixed assets, but we're only generating $2.01 of sales for all assets. However, this still is not bad. The next category, we have debt management ratios. The debt to capital ratio, or sometimes what we call debt to equity ratio, we see here we have an amount of debt divided by total invested equity. And so the higher this percentage is, the more financially leveraged a company is, and so the higher it is, the potential problem a company might have in the long run. The next one, times interest earned. This is a very important ratio because this is looking at a company's ability to pay future interest. And so what we want to identify is capacity, which is one of the 5 C's of credit. And so being able to see, and so in the case of the times interest earned, or TIE, it's better than the industry. And so that would definitely be a sign of financial strength. The next category, we see a lot of ratios: operating margin, profit margin, basic earning power, return on assets, return on equity, and return on invested capital. The return on invested capital is unique to Brigham and Houston textbooks. Return on equity, which is the 5th one from the top, is the most important ratio, at least from the standpoint of shareholder wealth maximization. And so we see here approximately 13%, which is important to note, and a good rate of return. Not exceptionally high, but good. Return on assets. Return on assets or return on equity. There is a relationship there that we'll see in the DuPont ratio here in a moment. And then we also see profit margin, the second one, that also has a relationship to return on equity and return on assets. The other two, operating margin and basic earnings power, we do see these in other finance textbooks, but they are not as common as profit margin, return on assets, and return on equity. So the effects of debt on these two. If we are not increasing our assets, but we are increasing our debt, we would see that equity would decline, which means that our debt to capital ratio would go up. Our interest expense would go up, which means that our times interest earned would go down because we're paying more interest. And so one of the things that we may see is if there is a reduction to net income, we may see ROA decline. However, if there is sufficient leverage using the DuPont identity, we can actually see the return on equity go up. So let's actually look at that through the DuPont equation. So the DuPont equation takes our profit margin, it multiplies it by total asset turnover. Well, if you remember, profit margin is net income divided by sales, which we see in the next line there, and total asset turnover is sales minus total assets. Well, if you take net income and divide by total assets, that is your return on assets. Then we have our equity multiplier. And we see our equity multiplier is taking our total assets and dividing it by our equity. And so what we see here is that ROE is not just a single calculation of net income divided by equity, but it is a series of ratios which are brought together, which shows a better picture of the company. Now, DuPont equation is named after the DuPont company, which is a very important and long-standing industrial company, and it was the managers of that firm over 100 years ago, which came up with this as a way of measuring a company beyond just the individual ratio of return on equity. The last category of market value ratios, price to earnings is important, especially for the current stock price. Of course, market price to book value is a variation on the market value added measure that we saw in Chapter 3. So let's look at a couple examples related to improving ratios. So we see here an example. We have sales per day, and how would reducing the firm's day sales outstanding to 32, of course, if you remember back, it was originally 45. We see here that if we encourage our customers to pay earlier, it would actually show an increase in cash. And so one of the things that you do need to think through is how these ratios work together to potentially create a strategic value for the company. And so this is one way of looking at it. Now, one of the things that we do want to be aware of is that ratio analysis is not the silver bullet, but it is a very important methodology that we need to know and be able to use. And so we see here that comparisons with industry averages can be difficult if the industry has a lot of companies that are not specifically connected to the company itself. So an example of that, if we are a television company, which all of them are owned by conglomerates today, but if we were CBS and we wanted to compare ourselves against the parent company of ABC, which is Disney, that doesn't really provide a good comparison. Also, we need to understand the difference between the accounting practices and the operating practices of the companies. And so, depending on management philosophy, our ratios can be very different. So this is why it's important to read the annual reports to understand how management is actually managing those firms. So it is hard to really say a ratio is good or bad, but it may tell us where there may be financial strength or financial weakness. And so we need to help understand, is there high profitability, low profitability, and we need to remove the value statements of good and bad. So this is Chapter 4 in very brief detail.